All right. So what you're saying is there's a chance. No, there's no chance. Look, full disclaimer, I'm not a financial advisor. You make your own decisions, you do your own research, you decide on your own thing, but I mean, which one are you? Dumb or dumber? Ulty or salty? I mean, honestly, think about it. So Salty was released. It went down, I think, to like 48 something. 48, closed the day at 48.99 and came up a little bit on after hours. But as I said before, Salty is going to go in to the 40s. Ulty's already in the fives, soon to go into the fours. It went the other night, overnight, into the fours, which is a leading indicator of what's going to happen. I think it was a forced liquidation, but I don't know. However, if you go on Yomax's website, in their ultra funds, Slty is married up in the same bracket as Ulty. And according to Yomax and other people online, Slty is the inverse of Ulty. So if Ulty goes down, Slty goes up. If Slty goes down, Ulty goes up. I don't see it. I don't see it at all. If we talk about Ulty, let's back it up a little bit. We're just going to back up the truck a little bit and understand the derivatives market. Now, I'm not a financial advisor. However, I do know how derivatives work a little bit, somewhat, in my own understanding. So, derivatives are derived from something. In the case of stocks, they're derived from the underlying stock. Commodities from the underlying commodities. And in some cases, derivatives can be issued by having collateral, right? That's how you get these synthetics. And I'll get into that in a minute. But however, how do you think these derivatives are created? They're not free to create. There are calls and puts, right? Where you can call away something or you can put something to someone. Those are the two types of derivatives. And now they can be married up in different ways. You can have many different types of strategies. You can have a synthetic strategy. You can have a covered derivative from the underlying. You can also have other vehicles that are a combination, like straddles, collars, broken wings, iron condors. It's just almost an infinite amount that can be created. And in all cases, they come with fees, right? So in the financial industry, the underlying premise is to make money. Make money for the financial organization that these agents are working for. When you look at Ulty, right, the premise is, as far as I can tell, again, I'm not a financial advisor, as they sell covered calls. They buy the stock, and then from the issuance of a sale at a higher strike, sometimes you can be in the money, but an out of the money, they're predominantly out of the money calls that they sell. And for a specific amount of time, and if the time expires and the stock price has not risen from the underlying, they collect a fee, right? Or a premium. Similarly, according to representatives, they buy protective puts. Now, if you look at derivatives in general, I would say 90% that I have noticed, protective puts are basically insurance for people who own the underlying stock. And they're normally more expensive. There's more intrinsic value because it's like insurance on your house or insurance on your car or life insurance, right? There's more value in protecting yourself than calls, which are trying to forecast the future. When it comes to Ulty, they're buying protective puts. And what I've surmised is they're paying way too much. So they're not generating enough premium from their calls to make it worthwhile to buy the puts. For example, let's say you have a specific underlying and you buy a 10% out, or you sell a 10% out of the money call and you collect $1. Then you buy a put at a similar distance and you pay 90 cents or half, you know, if you go half the distance, it could be 95 cents or 90 cents. The further away from the price you go, the cheaper it is to purchase. So net, they make 10 cents, 15 cents, sometimes a little bit more, sometimes a little bit less. So not only are they limiting their upside, they're also limiting their premium. You know, and they want to pay out 80+%. Now with the last distribution, it's over 100%. The amount of NAV erosion, net asset value erosion with this model that they're following is only going to lead to further declines. Now they're coming out with Slty, which came out the other day, and it's supposed to be the inverse of Ulty. So they're supposed to be selling puts. You know, in the derivative market, they'll be selling puts, which is a pretty good idea because if you like the underlying and you think it has a good future, you can sell a put and collect the premium. And if your assessment is correct, you just continue collecting the premium. And if it happens to be a market fluctuation and it goes below your put and they're put to you, you get an underlying that you like, and then you can sell calls on it, right? And in effect, create a wheel, right? However, it's too new. It's only like a day or two old. And the information on the Yield Max website is incorrect, in my opinion. So I don't know what they're doing. However, normally, when you think of an IPO, generally in a relatively stable market or an uptrending market, when an IPO comes out, it goes up in value. Everybody's excited about it. Like everybody was excited for Slty. Well, how much of that excitement translated into the price rise? First of all, there's no NAV that's specified. There's no amount of shares that's specified accurately, in my opinion. So the net asset value of Slty is, to me, unknown. I think, according to the numbers that I've seen, it can be anywhere between $3.5 and $350 million. But God, nobody knows. It doesn't look good when you hype one of your products, like YieldMax hype Slty, and none of the information on your website is seemingly correct to me. But let's get back to Ulty and what Slty's going to do. Ulty has an inherent problem. Its NAV is eroding exponentially. It's crazy how much NAV erosion. And you have to remember that they are listing their distributions as return of capital, so non-taxable return of capital to the shareholders. But it's not consistent because it varies. I don't believe in their explanations on YouTube about deferring taxation into the future. I believe that, in my opinion, it's actually return of capital, where you're getting your money back because they don't generate enough profit to cover the distribution, and hence erodes the NAV. This is a broken business model as I can see it. Now, I bought 52 of the YieldMax ETF funds. On Friday, I think I sold about 20 of them that have no, in my opinion, no redeemable features, and they're only going to decay in net asset value over time, and their distributions are not. I'll give you an example. Let's make a deal. I'm not a financial advisor, but let's look at this. You give me $100,000 and we'll sign a contract. You give me $100,000 and I'll give you 80% return over the course of the year with stipulations. Right? So 80% return guaranteed, right? And for that, I'll charge you 2% as a management fee. Okay? And I will give you a distribution of 80% on that money. Now, you have no say in how I invested. You have no say other than you're going to get 80% distribution rate. And whatever the value is at the end of the year, we close the contract, right? So you give me 100,000. I take that 100,000. I put it in short-term treasuries, yielding about 4%. And establish a trust. And in that trust, an 80% distribution will be allocated. Not on some companies give annual distribution, some semi-annual, some quarterly, some monthly, some weekly, like Ulty and Slty are supposed to do. But you'll get a distribution every single day, every single business day, Monday to Friday. It won't be every week. It won't be every month. It won't be every quarter. It won't be semi-annually or annually. It'll be every single day. Would you sign up for something like that? Sounds pretty good. Sounds too good to be true. However, if you break it down, you give me 100,000, I take that 100,000 and I put it into short-term treasuries. I earn about 4%. Because of the distribution on a daily basis, every day that yield that I earn from those short-term treasuries goes down a little bit, but over the course of time, it'll generate over that year about $2,000 in yield. And I'm charging 2%. So that's 4,000, right? 2,000 of the yield from the treasuries that goes into my pocket. $2,000 management fee that goes into my pocket, right? And I do nothing. This fund that I set up with the financial entity just sends to your account the distribution that would equal an 80% return over the course of a year. At the end of the year, right, you've received $80,000 in total, right, which is 80% of 100,000, right? I collect my $2,000 from the management fee, and I collect another $2,000 from short-term treasuries, because I'm totally in control of the money that you invest. Like when you put money into yield max funds, they are in total control of how that money is applied. So of the $18,000 remaining, right? Because 2,000 went to the management fee. 18,000 is remaining. I return to you at the end of the year, at the end of the contract, $18,000, right? So you look at it and you go, man, I invested 100,000, and I got back 98,000. Well, I lost 2%, right? Because of the management fee. They really didn't do anything, but at least they didn't lose my money. You are out 2,000, but I'm up 4,000 because I collected from the short-term treasuries and I collected from my management fee. Now you might think, oh, okay, well, it's only $2,000 and you made $4,000, but multiply that thousands upon thousands, tens of thousands of investors. In Ulty, there's over $3 billion in assets under management. That's a lot of money. That's a lot of money. My Uncle Ponzi thinks it's a really good idea what they're doing. But my Uncle Ponzi is married to my Aunt Pyramid. And, they're always up to no good. They're always up to absolutely no good at all. Are you dumb, or are you dumber, or are you both? For me, I'd like to see how this plays out. So of the 52, like I said, I sold 20. Some of them haven't even done their distributions because I haven't held them for more than a week and a half. I was just like, forget it. This is complete and utter disaster. In my opinion, disaster, right? Slty, being the inverse of Ulty, has the same structure. And it just blows my mind how you can look at it and say, okay, if one goes up, one's going to go down. And if one goes down, the other one's going to go up, and think that's a winning formula. in a marketplace that historically goes up and to the right. You know, just to tell you, like I'm over 60, I'm a pensioner. And when I first bought the S&P, it was 180, not 6,400 or whatever it is now. What is it now? Let me see if I can find it. No, it's not on the thing, but it's over 6. Imagine 180, right? When I was 20, the S&P was 250. Berkshire Hathaway was $2,500 a share. Time. I believe in the US economy. I believe in the Canadian economy. I believe in the world economy. And unless there's an asteroid, right, or an alien invasion, we're going to go up and to the right. Yeah, there's going to be times we go sideways. Yeah, there's going to be times we go down. But overall, it's up and to the right. So I'm a very positive person. So Ulty's cockamamie kind of strategy would lean more towards me. Slty's inverse of Ulty, it would be polar opposites. I would not be attracted to that. So I didn't even bother buying it. It's the one ETF I did not buy, and like I said, it's in the 40s already. It won't be long. Give it a couple months, and it'll be in the 30s, in my opinion. Like I said, I'm not a financial advisor. But derivatives, you have to employ a level of understanding that's far beyond the scope of an average person. I would wager that if you are involved with derivatives, and in this case, the Norman culture is call options and put options. That is technically an incorrect statement, but if you look at the vast majority of what you do, if you did the opposite, you'd have made more money. Right? Over 90% of all derivatives are successful only when they're sold. That means the buyers of derivatives have a 5% chance. Let's give it 5 to 10% chance of being in the money or making a profit. It is, for a buyer, a losing strategy. And when you imply covered calls in an upward trending market, it is also a losing strategy. And I don't see a future for these funds, especially when you look at the single stock ETFs that YieldMax puts out, where they're implying synthetic derivatives. I don't even know how that's allowed, right? Because they take all the money, like I said, I'm a manager, $100,000. They take all the money, or the vast majority of it, and they put it in to short-term treasuries. That's the collateral they use, right? And they earn an interest, right? However, when I'm managing your money, and I'm not a financial advisor, but I'm just saying in this scenario, in this hypothetical scenario, I just put it in short-term treasuries and never bother with it again. I have it self-rolling, and the team set up at the financial institution to send you money on a daily basis, right? However, these funds are actively trading derivatives. Those derivatives cost money. There's an underlying fee that you don't see because it's all within the activity, right? Because Yield Max is very clever. They cover their bases. They basically say we can do anything and everything. And this is how we're going to give you your money. So behind the curtain, how many shenanigans can be going on? Because there's the fees for trading. Now those could be counterbalanced, of those of you remember what happened in the past, with order flow. Because the order flow from the entirety of Yield Max can be possibly, I don't know for sure, compensated with revenues from order flow. There's so many things that are unknown. This fund is much, much too young. Both Ulty and especially Slty, that just came out a couple days ago. Be very careful, because people are always trying. How do people get rich? They get rich from people giving them money, sometimes for services, sometimes for products, but they only get rich if you give them your money. If you don't give money to a person or an entity, they cannot increase in value. There has to be some transfer, right? So for me, Ulty, Slty, are you dumb? Are you dumber? Or is there another moron coming? But these look like train wrecks to me. Be careful. Take care of yourself. And have a great day. Bye for now.